Hi, this is Ron Cipcic, and this is the second part in a two-part series on open market operations. In our first segment, we took a look at how the Fed's actions affect the level of excess reserves in the banking system and how that ultimately affects the potential money supply. And we begin this lesson by reviewing a few of the key principles that we worked on in the last lesson. Notice here that we carry forward the same example. The Fed buys $100 million of U.S. government bonds in the open bond market. Again, let's note that when the Fed buys bonds, that increases its assets by $100 million. It now has bonds on its books. Now, the Fed is holding these bonds. It's paid interest on these bonds. Effectively, the Fed has become a bond buyer and is a holder in its portfolio of government bonds. That purchase ends up creating a deposit in the banking system. So the bond sellers are going to receive $100 million in deposits. Now, the interesting thing is this deposit does not cause an offsetting withdrawal in the banking system. So in essence, this is newly created money. This deposit is created basically out of thin air. However, the bond sellers treat it as if it's real, only because it is real. The Fed has constitutional authority given to it by Congress to create money out of thin air. Deposits are money. The Fed has created deposits here out of thin air. That deposit, like any deposit, is going to create an equal amount of reserves, and those reserves are going to show up on the Fed's books as a liability. And as we said last time, the accounts close. Now, we also pointed out in the last lesson that these reserves constitute an increase in the monetary base. So the monetary base is increased. Well, if the monetary base increases, that's going to increase the potential money supply. And of course, banks are now in a position to create loans, and these loans will create further deposits. Deposits will create reserves. Reserves will create loans. Loans will create deposits, and this deposit expansion multiplier process will unfold. So what we see here is a small, relatively small initial action will have a much larger effect on the banking system than the size of that transaction. Now, in this particular lesson, we want to look at how open market operations affects interest rates. And so this is really what we're going to focus on in this lesson, is how does the Fed's actions affect interest rates. And so let's just go ahead and dive in. There's really two ways that the Fed's actions affect interest rates. When the Fed buys bonds, let's go ahead and write that out. When the Fed buys bonds, that is going to increase the demand for bonds. That is going to push up the price on these bonds, and that is ultimately going to push down the yields on these bonds. Now, this requires some explanation. The yield is actually what we call the effective interest rate, and we'll explain what we mean by effective in just a moment here. So the effective interest rate is the interest rate that the holder of the bond actually earns. And let's do a little example here and show this to you. We're going to do a little bit of a bond pricing lesson here, give you a little bit more understanding of bond finance. Again, let's go back to that government bond we talked about in lesson 1 that has a face value of 1,000 and a coupon interest rate of 3%. So this is the coupon rate. And let's say that this bond never matures. Let's just say, for the sake of argument, it's what we call a perpetuity. A perpetuity is a bond that doesn't have a maturity date. And this will simplify our calculations. You may think this is a bit of a silly assumption, but actually the British Empire, and there have been other governments in history who have actually issued what are called perpetuities or consols, and these are bonds that don't have a maturity date on them. Okay, now this bond is going to pay $30 a year. How do I get that? 3% of 1,000 is $30. Remember, this is called the coupon, and the coupon is simply the interest payment, annual interest payment on that bond. Now, if you take the interest payment and you divide it by what the person pays for the bond, let's say the person pays 1,000 for this bond, let's say they pay face value. So if you take interest and you divide it by the price, say the person pays face value, or it's called paying par, then they're going to yield, the yield is going to be 3% on that bond. You go, well, I know that because that's what it says on the bond. But in this case, the yield equals the coupon rate only because the price equals par, or 1,000. This is called the coupon rate. We talked about these concepts in segment 1, so I'm not going to spend a lot of time reviewing them. Now, let me show you something. This is kind of the key point. Say the price of the bond goes up to $1,200. So the bond is still paying $30 a year, but the seller of the bond is able to sell the bond now for $1,200. Well, that bond is no longer yielding 3%. Now, you may say to yourself, why would anybody pay more than face value? Why would someone pay a premium for this bond? Well, I'll show you why. There is a reason why. But let's first of all get to the yield. If you take the 30 and divide it by 1,200, what you're going to get is a yield of 2.5%. So effectively, what has happened here? When the price of the bond goes up, when there's an increase in the price of the bond, the yield on the bond, which we'll call small r, the interest rate on the bond, drops. So there's an inverse relationship between the price and the yield. The higher the price paid for a given bond, the lower the yield on that bond. Now you may say to yourself, why would anyone pay a premium on this bond? Why would they pay more than face value? Well, the fact is, interest rates must have dropped. In other words, a person is happy to pay $1,200 and earn a yield of 2.5% a year because basically that's what interest rates now are. That's what they can get on alternative financial investments. So it must be that at the time the bond was initially issued, the yield on comparable instruments was 3%. Interest rates for some reason have dropped, and therefore people are willing to pay more for the instrument, and effectively they get a yield comparable to what everybody else is getting in the marketplace. Now what we need to pick up now is the idea that an increase in the price of a bond leads to a decrease in the yield on that bond. Okay, that's the key idea here. Okay, we can flip this, and I'll just do the flip side of it really quickly here for you so you can see this. Let me go to a different color here. So let's say now, again, the bond pays $30. The coupon is fixed. It's by contract 3% on a face value of 1,000. But the bond can be sold for any price. Let's say the bond is sold for $900. It is sold at what is called a discount, below par. Well, what's the yield on this bond? This yield is going to be 3.3%. So what happened here is, as the price of the bond went down, from 1,000 to 900, the yield on the bond actually went up. So the drop in the price of the bond leads to an increase in the yield on the bond, the effective interest rate on the bond. So again, bond prices and bond yields are inversely related. So let's go back up to where we were before, and let's again summarize the principle. I'm gonna pull it all together here, and I'll use a little bit of a different color. When the Fed buys bonds in the secondary bond market or open bond market, that's going to drive up the demand for these bonds. It's going to push up the price of these bonds, and it's going to drive down the yields on these bonds. Now remember, the yields are the effective interest rates, not the interest rate which is on the bond. It's the interest rate somebody earns based on what they paid for it. Now you go, so what? So what if bond yields drop? But keep in mind, if bond yields are falling, that means interest rates in general are going to fall. In a way, you can think of interest rates on government bonds as being a base interest rate or a risk-free interest rate. So other interest rates will drop if yields on government bonds are dropping, because many other interest rates are actually built off of the risk-free rate. Okay, so let's go ahead and I want to show you one more thing related to number 1 here. And we can actually draw the bond market. And I'll draw a picture here of the bond market so you can see this. And erase that. Back up here. Let's go back to black. And let me use this graphing function here real quickly. So we're going to draw this graph. So we need a supply and demand curve. And this is our supply curve. This is our demand curve. And this is the bond market. Yes, you can use supply and demand to talk about the bond market. And here's the equilibrium price of bonds. This is the price of a bond. Price of the bond 1. This is the quantity of bonds. This would be a dollar volume. And who issues the bonds? This is S1, D1. The supplier of these bonds would be the government, and the demander of these bonds would be bond holders. And one of these bond holders could be the Fed. The Fed could be in this group right here. Okay? Now, if there is an increase in the demand for anything, that's going to shift the demand curve which way? It's going to shift the demand curve to the right. So let's go ahead and label this D2. Whoop, sorry about that. Let me get back to the right. So this is now D2. So there's greater demand for bonds. The Fed has increased. The increased demand is caused by the Fed. The Fed's increase in demand. Okay. Now, what's the effect of that? That's going to push up the volume of bonds traded. More bonds are going to be sold, but in dollar terms. But that's also going to push up the price of the bonds. So the price of bonds. But excuse me. So let me just clean that up. So the price of bonds is going to increase. So the increase in demand is going to increase the quantity of bonds sold in dollar volume and increase the price. Now, what this doesn't show is the yield over here. There's going to be a decrease in yield. And the yield is a percentage. This price over here is in dollars. Okay, so as the dollar price of the bond goes up, the percentage yield on the bond goes down. And that's effectively what the Fed can do. Okay, let's go ahead and look at the second possible way that the Fed affects interest rates. So I'm going to go label this number 2. There's 2 pieces to this. And when the Fed buys bonds, that's going to increase a supply of loanable funds. So now they're loanable funds. And that's going to create a surplus of loanable funds. You can see how supply and demand is so important here. The supply and demand modeling we did at the very beginning of the course, even though that is microeconomics, we can use that model in terms of talking about macroeconomic outcomes. So we're looking here at the loanable funds market. When the Fed buys bonds, it's going to increase the supply of loanable funds, which is going to what? Create a surplus of loanable funds. Why? Because keep in mind the Fed has injected excess reserves into the banking system. There's more excess reserves in the banking system. So when the Fed increases the level of excess reserves in the banking system, it has effectively increased the supply of loanable funds, creating a surplus of loanable funds. What's that going to do? That's going to push down the interest rate on loans. Okay, loans are going to get cheaper because there's more liquidity funds in the banking system. Just like up top, the Fed's action pushed down bond yields. And by pushing down bond yields, it's now cheaper to issue bonds. If bond yields are lower, think about this. If bond yields are lower, if yields on existing bonds are lower, then it's going to be cheaper for people to issue new bonds. For instance, if the Ford Motor Company wants to issue bonds to finance the purchase of a new factory, it's going to be able to issue bonds at a lower interest rate. It's going to be able to borrow at a lower interest rate if bond yields in general are quite low. So what the Fed has done is the Fed has lowered the yields on bonds, and the Fed has lowered the interest rate on borrowed money through the banking system. Okay, and again, we can draw a picture of this. So let me go ahead and do that. This is going to be a different market. This is going to be the loanable funds market. So let's go ahead and draw that. And it's a supply, one. And who are the suppliers? Lenders. This is loanable funds. This is going to actually be an interest rate. This is going to be a percentage interest rate. This is going to be the quantity of loanable funds in dollars. Okay? And who's the demander? The demander would be borrowers, members of households, businesses. So anyone who borrows from a bank, borrows through some sort of financial institution, is going to see lower interest rates here in just a minute. So this is R1. This is Q1. Now, what happens here when the Fed purchases bonds and pumps liquidity into the banking system? Well, the supply of loanable funds shifts to the right. This is S. Whoop. This is S2. And notice when a supply curve shifts to the right, the initial thing that happens is a surplus. We showed this earlier in our microeconomic lessons. So the surplus will ultimately lead to a lower price. Well, here the price is the price of borrowed money. So the interest rate drops, and when interest rates drop, borrowing is going to be cheaper. And of course, the quantity of loanable funds increases. You've got a greater supply. So you got lower interest rates, and you got a greater quantity of loanable funds. So we see two effects by these open market operations. In both cases, the effects are lower interest rates. First, in the bond market, the very act of buying bonds and the kinds of quantities the Fed buys bonds that very act is going to end up pushing bond yields lower. Lower bond yields mean it's going to be cheaper to issue new bonds. Okay, so interest rates on bonds, a very popular way of borrowing both at the governmental level and at the business level, those yields are going to drop. And then secondly, we're going to have much lower interest rates. We're going to have lower interest rates in the loanable funds market. So in other words, by injecting reserves into the banking system, this is the bond market, I got to keep going. By injecting reserves into the banking system, what did the Fed do? By injecting reserves into the banking system, the Fed has what? The Fed has, I'm sorry here, let me get rid of that. The Fed has increased the supply of loanable funds, created a surplus of loanable funds, and pushed interest rates down. So car loan interest rates, home equity loans, consumer debt, where you're just going in and buy credit card money, all these kinds of interest rates on installment debt should drop as a result of this. So one of the reasons, key reasons, why the Fed engages in open market operations and tries to put a lot of liquidity into the banking system is to keep interest rates relatively low, to make it cheaper for people to borrow. And we can summarize this lesson by showing you this little model here, that when the Fed buys bonds, and this is called open market operations, it pushes down interest rates on bonds, effective yields, and interest rates on loans. That action is going to push up consumption. Consumption is household spending. Household spending will increase. That action should push up investment spending. Investment spending is business spending on capital goods and inventory. So lower interest rates tend to encourage households to borrow and spend. Lower interest rates tend to encourage businesses to invest, and the effect is greater spending. Well, what's that going to do? It's going to push GDP higher. Now we're ignoring prices here, and this could be a consequence of this action. We could end up having higher prices. But right now we're going to ignore the price level effect and simply, so this is expansionary. And when the Fed is engaging in expansionary monetary policy, it's engaging in a policy that is expansionary with respect to GDP. And of course, macroeconomists are very interested in this because this should lead to lower unemployment. Okay, particularly lower cyclical unemployment. All right, this concludes our lesson on how open market operations affect interest rates, both in the bond market and in the loanable funds market.